Good morning, traders. Today is August 28th, Sunday. And I know this chart looks a little complicated, but I'm going to try to explain what's going on in the major markets, the U.S. markets, and with the big move on Friday, extended selling. The Dow Jones was down almost 1,100 points. The NASDAQ was down almost 600 points. And the S&P was down almost 158. That's the ES, the E-mini S&P, the NQ, and the YM. These are all quoted off the E-mini contracts. The SPY was down 14.20, down almost 3.4%. We had big moves. Gold was down 1.16%, down 20 bucks. Silver was down 34 cents, 34 and a half cents. Crude oil was up 45 cents at 92.97. And we're really seeing a kind of a shift here. Let me explain what's taking place right now. The markets have come down from these levels near 480, this is the SPY, down to this 360 level, okay? And then has recovered all the way back up to this 430, 435 level, and now has rolled all the way back to this 405 level. We are in a very broad expanding wave. So if you take a look at these lows, from here across to here, we are in a very broad expanding wave as we move lower. But we've seen this before. We've seen this play out before. There's two things that could happen at this point, which is why we're kind of in a never land right now. That is that we had very broad selling on moderate weak volume. That tells me that this was more of a reactionary move, not a new trend move. Yes, the Fed is likely to continue to raise rates, and it's likely to continue to put some pressure on the markets. But the Fed has already started to do some damage to consumers and the capital markets, and I believe the Fed's going to move softer, maybe with 1/4 or 0.5% interest rates increases over the next couple of months, trying to see how the market digests what's actually taking place and be less aggressive in terms of global contagion event crisis. I think they've determined they've moved sufficiently, and now they need to move a little softer. That's my opinion. This also means that we have continued risk of foreign market crisis, capital market crisis, and big debt issues. China just issued a trillion yuan stimulus trying to kick their economy into high gear. This seems very similar to what happened to the U.S. after 2008 and 9, after the global financial crisis, and it seems very oddly similar to the fact that China now and Asia could be moving into a extended, let's call it credit contractionary phase, very similar to the global financial crisis, which if you have been following me long enough, you know I've been warning about this for more than a year and a half, okay? I've been telling you that China is going through the same thing that we went through between 2004 and 2008. They're seeing a massive speculative bubble that's driving asset prices across the globe higher and higher, and it's going to come to a time where there's a reckoning period. And a reckoning period, to me, is not necessarily a massive global collapse, although that could happen. A reckoning period is a period of -10 to -20% economic activity on an annual basis where the economy slows, stagnates, prices decline, possibly 25 to 40% for general assets like houses and other assets, a real economic malaise, a longer term 4, 5, 6 year economic malaise, just a sideways, go nowhere type of trend. Now, longer term, I see this as very strong for the U.S. markets. We need to try to find a bottom over the next couple of months. And we're moving into the end of the year where we're likely to see October, November, December type of a rally. So we need to be attention to the fact that we're really only about 30, 40 days from moving into October. We could begin a rally phase, a Christmas rally phase. Depends on how the U.S. consumer stays healthy, whether or not we're going to see any type of new contagion event. And what I really want to point out here is this green box area. Let me try to spread this out and show you a little bit about what's going on. So we have this window. And again, I have a lot of lines on this chart. I'm sorry. There's Fibonacci retracements going on here, trend channels, broader trend cycles. But if we take a look at this, and maybe I'll go to this chart, which should be in the same scenario, yes, and go here. This is my Fibonacci price modeling system. And what I'm going to do is move it to the SPY on a weekly basis. This is cleaner. So what we have here, ladies and gentlemen, this is the weekly SPY chart. The other chart is daily. And what we have here is a very clear picture of trend. So we have two things that are going on here. We have an A, B, C, D, possible E wave down into these areas. You can see this is where the Fibonacci system is predicting. Or we have an A, B, C ending wave, which may turn into an A, B, C, D, E move back to the upside, possibly only up into this area, possibly higher. So let me draw the alternate wave cycle. So we go to here, here, up to here, down possibly to this area, and then possibly up into this area through the end of the year, and then roll back into a new wave to the downside. This could be our wave 4 right here. This could, or what actually would be a ABC down wave, ABC up wave, staying away from this ultimate peak level here, which would become our critical price zone. And price could meander in this window for a period of time, for a period of time, staying in this zone, returning up to maybe 440, 460, maybe 470 up into this area before rolling over by the end of the year. So there's two things that we have to be cautious of. Number one, a breakdown. You can see these levels right here. So let me highlight this level. And I want to show you that this becomes a very critical level. And that's the area that I've highlighted on the other chart. This becomes a very critical level for us moving forward. We're right down into a support zone here where we could see the markets roll over and start to move higher or break below this 400 level and really break to the downside. Ultimately, this level down here becomes our Fibonacci price low, telling us that we need to be very cautious of this level for future downtrend. So we could see the price move from where it's at, 406 roughly, all the way down to 362, find a support around a double bottom, and begin to move higher. So there's two outcomes we're looking for here, and I'm watching this 400, 401 area as critical support. When I come back over to this chart, you'll see here that I'm watching this area here, this I've drawn it here from 398 to 408 as an area of critical support. I've drawn multiple Fibonacci retracement levels over here, and it's very difficult for you to see, but if you take a look at these areas, we have a 382 level right here. We have another 382 level right down here. And then we have another 382 level right here. These are all off of the last, the moves downward from the peak. And what I want to highlight is we're still above these, technically above these conglomeration of 382 levels, which I've highlighted in this green box. These 382 levels are moderate correctionary phases. We could see it move down to a 25 level here, or even a bit lower. We could see it move down into these levels below, right into this lower green area, this little purple area here, and still qualify for a broader uptrend. So we could see it sell off a little bit more, roll around, find support, and qualify for a new uptrend. This still qualifies as a down cycle phase until we get above the all-time highs up here at around 480. draw my map, about 480. But understand that we are in kind of a no man's land right now. The reaction on Friday was reaction to Powell's comments. I don't see any real volume out of it. I don't see really any momentum behind this trend. My trend indicators are still bullish for the SPY, the YM, and others. The NASDAQ is bearish, so we need to watch the technology sector potentially unwind. But understand, right now, I would urge you to not get married to a position. You're better hedged and protected and waiting for the market to make a move. Depending on what happens over the next couple of weeks and whether or not we break below this 401 to 397 area, if we get below this area right here, then I would strongly indicate that we're likely going to try to move down and retest these lows. If we find support in this area over the next couple of weeks, then I would strongly suggest this could be a pullback in an uptrend, a moderate, and this is an uptrend in a broader downtrend, as I pointed out, and we could see another rally back up here to 440, 445, maybe even to 450, but we need to see what's happening right now. This is reactionary, and I don't believe this trend has any momentum yet. I don't believe the Fed is capable of executing anything that's trying to break this momentum, and I believe currently the global markets are a greater risk, and it's driving money into U.S. assets, gold, silver, and Bitcoin, actually. So now let's talk about Bitcoin. Let me come over here. I put together a video just yesterday showing that Bitcoin is likely to attempt a very big upside move based on my predictive modeling system. So we're going to come over here to the weekly chart, and I'm going to show you that Bitcoin, based on my predictive modeling system, tells me that it's got to get below 18,200, 18,300 roughly, give or take $100. And then there's a very big chance we could see an upward move near the end of August, early September. Let me go to daily. It'll show you a little clearer. The reality of this move is that Bitcoin needs to move downward in this cycle, needs to come down below this 18.3, 18.4 level. And then in doing so, it's going to set up a capitulation rally, which is going to be essentially a speculative rally that could move all the way up to 3,000 or 30,000 to 35, 36,000. We're seeing Bitcoin move downward already. What we need to see is another probably 2,500, 2,000, 2,500 to the downside before we may see this speculative phase. And this speculative phase right here could prompt or be prompted by some kind of a catalyst event. Possibly global, possibly U.S., don't know. But gold and silver, I believe, and Bitcoin could see a very solid rally. And this is, again, my predictive modeling is suggesting that price will stay within these yellow trends, move downward around this 18,500, 18,400, 300 area, and then bottom very quickly and begin to move higher. And where I'm looking at is I'm looking at an area kind of right in this area as key support to the upside. So if it bottoms, as I predict, and gets back above, say, 21,000, say 400, on fairly strong upward trending, then we have a potential to see another 8, 9, 10,000 or more to the upside for Bitcoin. And I believe this is going to potentially send gold and silver skyrocketing as well. I believe the whole concept of the Bitcoin rallying is that we are also going to see potentially gold and silver kind of do the same thing. I think we're going to see it potentially weaken, come into this area. As you can see, it's rolled down, potentially weaken around, and then start to really move higher. As I told you, this speculative phase, if it takes place, could be as a result of some catalyst event. I don't know what that would be. I'm watching for it, but it looks like early September is going to be some sort of a catalyst event, which could send gold, silver, and Bitcoin moving quite a bit higher. Okay, so now lastly, let's come back over here before we get to the other charts. So again, we are in a perfect position right now. We are hedged. We are generally long because my rotational modeling system is showing us that we are long. We're in this neutral zone. I need you to be very aware that we do not have any real impetus or momentum behind this trend yet. We had fairly strong selling. I'll show you in the custom index charts exactly what's going on. And in fact, let's take a look at some of these custom index charts real quick. So first off, the trend system. The trending system, the NQ is bearish, bearish. It has been bearish, bearish for quite a while. In fact, I had a talk with somebody just yesterday. Told me he lost $26,000 in the markets being long in technology on Friday. And it's just some guy I met in a local area over here. And he was somewhat argumentative and didn't really understand the terms bullish and bearish because he was arguing with me when I told him my systems had been bearish, the NQ, for many, many months, and that we had been actively protecting since August of last year or earlier. Anyway, long and short of it is you need to stay aware of the risks in the market until we have solid trending. Now, what this tells me, if you look at this, stick with the top six here. NQ is bearish, ES is bullish, YM is bullish, Dow Jones Industrial is bullish, transportation is bullish, and SPY is bullish. So generally, we're still in a longer-term bullish trending mode, long and short-term bullish trending mode, except for the NQ, which is, again, why we have to understand that this is telling us that there is opportunity to the upside. We just need to be prepared for it. Now, my cycle counts are telling us that we're going to see potentially some sort of a downside or catalyst risk for a global crisis event, which is why we are hedged the way we are. And I'm going to show you that gold and silver are actually holding up very well. Energy is holding up fairly well, as you're well aware. 92, 93 for oil is pretty good. But technology is really unwinding. It's almost like a dot-com bubble all over again. And depending on how markets play out, we could see this continue to weaken, and technology may be a catalyst to go see the markets move lower. And that could be a very big issue overseas in China and Europe and Asia, not only in the U.S. Now, overall, we are doing, nothing has changed. We don't need to take any changes to our allocation. Nothing changed this week with the rotational modeling system, even though the big sell-off on Friday seems aggressive. Longer term, we are still moderately bullish with the NQ and bearish trending. I just showed you that. I suspect the Fed will still need to to raise rates combating inflation, but this will put additional pressure on the global markets, but we need to be patient right now. The markets are unsure. And that's really what I want to tell you. The markets are really unsure of where they want to go right now. We are in perfect position. We have a little bit of money in stocks. It gives us the ability to ride out these trends. We've got quite a bit in cash, so we're taking advantage of the strong U.S. dollar. If you have your money in U.S. dollar assets, we're hedging ourselves with metals, which, as I just explained to you, could see a big explosive move over the next 20, 30 days or more. And we have a small position in bonds, which hedges us even further. Now, in our alternate position, if you can't hold metals, we've got 30% in stocks, we've got 50% in cash, and we've got 35, 50, and 15 in bonds. So what we're trying to do here is move our money into a diversified portfolio that protects us against downside risk. Imagine, that guy that said he lost $25,000 in the NASDAQ. In this position, if you had only 25% of your money in stocks and you had $100,000 and the markets moved down 3%, that would only be a 0.75% loss for your stocks, while the dollar rallied, metals held up okay, and bonds were sideways flat. So in reality, in this manner, we negate some of the extensive risk of being 70, 80, 100% into stocks like most people are staying through this entire trend. And they're really following, I don't want to say it the wrong way, but let's just put it this way. You're better off trying to manage your risk through these periods, because we're not going to have the 20 to 25 or 30% drawdown that we've experienced in the markets. And understand, when we come back over here, and we take a look at the SPY, hypothetically, how big of a drawdown have we seen? Well, you tell me. I believe we're at about a 24% drawdown right now, and I believe we've been as deep as about 30%. So we'll just draw a line and find out. Hypothetically, we've been about 24% down, and we are currently at 15.2% down. And that's just the SPY. If you've been in other more volatile sectors like technology, innovation, or others, you could be experiencing a 35 or more percent drawdown already. Okay, so let's go to the FANGs index. FANGs index moved broadly lower last week. It's back into this upper blue channel, which we've seen before act as resistance and support. We need to see how it holds up in this area. We do have some type of bottoming indication here. We do have looks like a triple bottom type setup right here across this green channel. We could come down into this support level, this 140 area, 618 area, find support over the next couple weeks and begin a broad move to the upside. We would need to see it clear. You can almost see a line right across these highs coming down. And I'll draw it for us before I upload this chart. But we would need to see the FANGs index get above that price channel with some strong upward volume to actually mount a new upward price trend. If it stays below that channel, we should expect it to continue to move lower. And remember, technology right now is weakening, and this is going to be an issue going forward for technology. Although I will tell you that there's a strong likelihood that if global markets weaken, you could, and technology, certain technology like Microsoft, Google, Amazon, others are still generating decent earnings. You could see a ton of money roll back into some of the big technology companies for safety. Next, we have the U.S. stock market index. You can see we've got a downward trend channel here. Same kind of line. I'll draw it again before I post this up. We could see the markets move back down into this area, potentially into this area, this lower green area here. This is essentially what I talked to you about very early in this video. Markets are in a kind of a sideways, nowhere land. You can see the support level I drew across here. We're up above support. We've sold right back down into this critical support level. As much as everybody wants to tell you that the markets are going to tank and move lower, I'm going to tell you right now that we need to very much stay cautious. It is a 50-50 scenario as to what the markets are going to do next week. We need to see how the markets are going to trend from this area, and the markets need to show us direction. We are in a sideways trend. We have about a 60% chance of a wave 5 to the downside. We have about a 40% chance of finding support and seeing a wave 3 or wave C to the upside, likely targeting this upper area right over here. But we have no direction right now. After Friday's move with the Fed and Powell's comments, we need to just stay cautious and stay protected and see what happens going into the markets on Monday. The smart cash index, which is the global cash index, a global market index, was flat and down as a small little doji. You can see we've got this downward trending, so we are in a weakening trend. We have almost no direction in this global market index right now. We are down near support levels, down here below this gap right here. We're into the COVID lows in the global market index. We need to really kind of see how this plays out. This is, for what we saw on Friday, the global market index was extremely nebulous. Next, the metals index. Okay, metals are holding up very, very well. And I know that a lot of people are like, well, metals haven't done anything for a year and a half, almost 2 years. Yeah, I know that. But in the grand scope of things, metals have reached to near all-time highs, above 2,000, back over here and back over here. The dollar has rallied considerably, which should have put quite a bit of pressure into the metals markets, which didn't. Commodities rallied after the 2021 cycle, and gold held up very, very well. We've seen gold selling off recently as fear and commodities continued to rally, particularly energy prices, which is a scenario, in my opinion, in the grand scope of things, metals are holding up exceptionally well compared to the grand scope of what's actually taking place. And I believe once the gates open, so to say, like a horse race or a dog race, once you see the gates open for metals, the move upward is going to be incredible. I believe the fear and the contagion of a credit crisis is going to be just incredible to the upside for metals. I believe this 1690, 1700 level in gold, which is what you're looking at near this green line, is becoming what used to be the 1300 area for gold. This is now becoming our base equilibrium, our what I call a momentum base right here. And I believe the next phase higher is going to be quite impressive. Let's just say that 4,500, say, gold is not out of the question. In fact, that might only be about a halfway point. Okay, so let's just understand that gold is still bullish. We have some support here. If we get below this line, then yes, I'm going to change my direction on metals. But this has been very, very strong support. Until that support is broken, I'm not changing my direction in metals. I see this as a very strong upside opportunity. The valuations index collapsed just like I predicted. After a couple weeks back up, a couple of weeks ago, we were back up near these highs. This is telling us that generally the market continues to unwind. You can see that the valuations index moved into a bearish trend back over here, has stayed in bearish trending through the entire 2022. We had a little bit of an upward move over here before it peaked. We are establishing new lows, or will be potentially establishing new lows. And as I mentioned to you, it needs to get down into this red area to really wash out excess valuations. We're still fairly high as far in terms of valuations in the U.S. The PE ratio is, I think, 130, 140. I'll have to look that up. But we need to wash that out. We need to get down into normalized valuation levels before we can really mount some sort of an extended rally. The commodity to gold index is doing the same thing. Big breakdown last week. And this is again Fed. And this is again essentially commodities, primarily lumber weakening compared to gold. Gold is holding up actually quite well. You're seeing here that we're in a downtrend. We're in a deflationary cycle. We need to see it again move back down into these low cycles. This is COVID. So understand that extreme lows will get us way down into these areas. I'm looking at 1.0, 1.2 as moderate lows, maybe 0.8, 0.9, which will put us in the middle of this red area. But we're in a broad unwinding cycle phase. That doesn't mean we can't see some rallies take place. But ideally, we need to see this kind of unwind a bit further. And I believe the Fed's moderate rate increases will push us in that direction. Okay, the volatility index broke downward. I warned you about this a couple weeks ago as we were moving higher here, that this magenta line has been playing a very critical role in this contracting phase. So it's kind of hard to see, but from this ultimate peak, we have kind of an A, B, C upward, which is call it a wave 2. Then we have an A, B, C. Now we have a wave 3. Now, will we get an A, B, C potential downward phase? Maybe. Or we could see it roll back down here into this lower area, call it 7, 6.5, 7, potentially find support around 6 here, and then potentially start to rally and break out of this. So we are in nebulous trending. We do not have any massive trending. We had some bearish trending back over here, which we're all aware of. We have a potential for an upside peak over here, but we are seeing generally nebulous, tightening, sideways trending. If I were to tell you what I believe is likely to happen, I believe is likely to potentially generate some sort of a washout low, maybe, and then attempt to find some upward activity. I believe the U.S. markets are going to find strength while the global markets weaken. and currency crisis events take place, and that could shift trillions of dollars into metals, Bitcoin, and the U.S. markets and the U.S. dollar. Okay, that's the end of these. So I'm going to leave this here. We are going to move over to the volume ratio index. So even though we had fairly strong downward selling last week, we had moderate upward volume activity. You can see we didn't have the big buying activity like we've seen a couple weeks past, but we did have moderate 7.38 upward to downward volume activity. So that tells us that there's still quite a number of buyers out there, which is why we have to be cautious. We haven't seen any real massive breakdown. Now remember, we did see in early COVID some selling pressure, which was weakened. You can see here, very weak into the early portions of COVID. Then we started seeing buying, big buying opportunity. So we need to see what happens over the next couple of weeks. This volume level is still strong. It's equal to COVID levels, but we're not seeing that real consolidation, that deeper equilibrium, let's say, between buyers and sellers. Now understand that there's a ton of money that comes in every week and every month as far as income, earnings, contributions into ETFs and retirement accounts. So there is a huge amount of money that comes into the stock market, which continually perpetuates kind of a moderate buying basis. Right now we're seeing speculators really trying to buy into this dip. And again, they may unwind. If they really do begin to unwind, we would see something like this. But in a scenario where it's just a news-based blip, kind of an anomaly that's not a real trend change, then we're going to see continued positive activity over here on this indicator, which we're seeing, which gives us a little bit of a bias to the upside. Next, we have the U.S. Custom U.S. Devaluation Trend Index. You can see it is weakening here. We have a very clear ABC pattern. We need to see how this plays out and watch these lows. This is a low price level of 1.5 off of an extension. I'd have to take a look at where that's coming from, but we really need to watch this low. This last low is where we need to be cautious of a further breakdown in the market. You can see we have downward trending here. We haven't broken into a real strong downtrend yet, but we have downward trending. So we're in that nebulous phase right now. Custom General Large Cap Index, which is what this is showing us some moderate strength in a depreciationary cycle. Again, we're in that nebulous phase. This is a monthly chart. We have this sideways activity. If the U.S. market finds some strength, we could see it try to rally back up to this 1.22 level. If it finds weakness, we're going to see it break down below this low. So right now, we're kind of in a very nebulous phase, whereas my rotational modeling system is telling us it's generally bullish overall for the U.S. markets. Here is the U.S. in blue to global market index in red. You can see I've indicated that this would be a general support zone for the global market, this red box, and this blue box would be a general support zone for the U.S. markets. We came close to that area a couple weeks back on the low. We're still in this downward trend cycle, which is very clear, and I've indicated the downward cycle to the global markets here. Again, nebulous trending here. You can see A, B, C. You've got a very clear wave here. In fact, you can almost argue A, B, and then A, B, C, 1, A, B, C. So you have an A, B, 1, 2, 3, wave 3, wave 4, A, B, C, wave 5. So that completes a wave down. Now we're looking at a wave up. We could have had an A, B, C, D, E wave back up. Could end up over here before we start moving downward. So right now we're in this nebulous phase, ladies and gentlemen. We don't have very much clarity. We have no real breakdown in trend. And my rotational modeling systems are not telling us we need to be uber or excessively cautious or excessively aggressive regarding a trend. So here's the custom global assets index flagging out, moving sideways. And again, this is a fairly strong indication that the markets are seeking out a new trend. So understand that the global assets are really not weakening. They're holding support, trying to find a bottom, and we need to see how this plays out. Okay, that's the end of those. Next, we will go to U.S. real estate. U.S. real estate has moved considerably downward. Now, the one thing that I find very interesting is active listings, which is the dark orange line, has started to come back down. I believe traders or sellers are pulling real estate off the market right now, knowing that conditions are weakening and buyers are not really playing the game. So I believe they're pulling real estate assets off of the listings, but prices are coming down. Average days on market are going up. We're seeing reduction counts continue to stay excessively high, even though they have been dropping. We're seeing them stay excessively high. We have the, we have the median price level, the blue line, continuing to drop. This, I believe we're going to see this continue to move higher. I think listings are going to shoot up towards the end of the year as we potentially start to see more foreclosures and people at risk trying to get out. I think prices are going to continue to come down. Days on market's going to continue to move higher, and reductions will eventually start to move back up to the upside. Okay, next, okay, we have those. Here is my new real estate market updates. I've broken these down a little bit further. Let me see if I can try to show you kind of what's going on. And what we have here is real estate price trends. Real estate prices had been moderately above, so understand the 10% year over year. So now we're sitting over here at just below zero. So we're roughly at minus 8% general. This is throughout the entire United States. So understand that we're at minus 8%, minus 6% over here. This is really quite low when you consider we had these deeper 2019 lows. Then we had the COVID lows. Then we had the price decline after the peak in COVID. This was August. So we're getting down into general weakening trends for prices. Price reduction activity is still excessively high, even though lately reduction activity has been weaker. Home price reductions are not accelerating as fast as they were, but they're still quite high overall total market. New active listing counts have collapsed. They're not minus 7% roughly, meaning that no new homes or very few new homes are coming on the market. And overall new listing count metrics, this shows us essentially new count change, and share of market, which is the gray area. So you can see here new count is flattening out, new count change is actually decreasing, and share of market, which is kind of hard to see because it's very narrow, stayed relatively flat. So what's happening here is there's lesser and lesser inventory on the market. I believe people are just pulling homes off the market, waiting to see what the Fed is going to do. And I believe the Fed's going to raise rates by about 50%. So we'll see, or 5%. Sorry, 0.5%. I got to get it straight. Okay, the new TT scanner, hot list. Look at this. Nothing has really changed. Okay, so we really have energy still very strong. This would likely change if we see a catalyst in the market breaking down. Energy would break down and move into a flat position, and gold and miners would move into a neutral flat position, possibly turning generally bullish. You can see generally bearish, 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 couple of bullish, couple of accumulation over here in consumer discretionary, in global technology, in the QQQ trust we have accumulation. We have bullish over here in banks, and home construction is seeing a little bit of accumulation. But we're in a very general neutral market trend. Other than energy being bullish and metals miners being generally bearish, again, we haven't hit any targets. We're looking at some moderate profit in the trade, 20%, 12%, and 18%. But what's happening here, ladies and gentlemen, everything's moving sideways, like I showed you, in a general trend. In fact, let me come over here and just show you. So you can see here this general trend. We're moving sideways. We found support. We've rallied out of it. Now this whole area is basically a big expanding wedge. We have a lot of volatility. Something very similar happened in 2018, if you remember, and 19. But now we're basically in a very general, nebulous, no trending area. Overall, probably a 60% downside risk, 40% upside potential, but this critical support level and a potential of retesting this midpoint area, this lower green area, is very strong. We need to see what happens over the next couple of days before we start making any directionary changes. And again, if the rotational modeling system rolls back into bullish for the NQ, then we will likely move back into bullish for the NQ as well. Okay, so now I'm also showing you, and I don't think I have this here, I've added this new hot list for all Mint.com members. This is what I call the value scan. And it says basically the same TT scanner system, but these are all value stocks. And I'm sorting them based on the bullish bearish ranking. And I'm going to do a video today showing you how to use the thrust scenario and the profit factor scenario data to try to determine the best trading setups. Now understand that what we're looking here in value, the markets move in two typical modes. In low interest stimulus environment, and you want to be involved in growth and technology and innovation, S&P and QQQ. That's when we're typically seeing very strong rallies across growth and innovation and technology. When the markets are contracting, the Fed is raising rates, and there's uncertainty, then you want to try to move away from the growth sector and technology and innovation sector, which typically do poorly, and you want to try to move back into value stocks. Think of value stocks as like the toothpaste, toilet paper, Johnson & Johnson, 3M. You can see the list here. Coca-Cola, Cummins, Honeywell International, Smuckers, Nike, Intel, Verizon, Johnson & Johnson, JP Morgan, Walgreens, International Business Machine, Kimberly-Clark, Merck Shipping Company, Visa, American Express, Dow, Travelers Company. Essentially what happens here is you want to move to more consistent earning and dividend type producing stocks, things that will do well or moderately well no matter what the technology sector or the innovation sector does. So this gives you another opportunity to try to look at and diversify your portfolio given the 25% stocks. So remember, we're over here, we have our 25% in stocks, and we have 35% in stocks here. So with the TT scanner and the new value TT scanner, you can now have better diversity across your stocks to be able to deploy these more efficiently. And remember, we have ES, YM, transportation, and SPY all bullish. So industrial, S&P, transportation, and SPY are all bullish. The NQ is bearish, which means we want to avoid technology, innovation, marijuana typically. I mean, we want to avoid the more speculative stocks and try to invest in the more blue chip value stocks, giving us a greater opportunity to ride this out. Once the NQ turns bullish again, then we can diversify a bit more over into the technology innovation stocks, possibly marijuana and other stocks. But right now we want to stay very, very cautious and try to protect our money while growing our money. And we're going to do that using these value, there it is, these value stocks. So you can see bullish, 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 bullish here. We've got a long trigger in UNH, and we have a long trigger in Chevron. You can see they got 40% here in profit, 39% here in profit. We've already hit our targets. We've got some bearish selling here in Verizon, Intel, and Scott's Miracle-Gro. And then we just had a trigger here in Hasbro, a flat trigger. But generally, if you look at this list, which is ranked from strongest bullish trend to weakest, or here's the weakest bearish trend right here, these -9s, -7s. But generally, you look at the symbol, whether it is ranked bullish or not, whether it is in a bullish trend here, and then ideally what you're looking for is something that's pre-trending. So if you get into something that's bright green like this, which is, come all the way over here, PFG, which is solid, this means it's already in an uptrend, it's trending higher, the thrust indicator is telling us it's moving aggressively higher, but the profit factor number is at 0.86, meaning it's fairly low. So this might actually be a good opportunity. What I like to do is I like to try to find stocks that are in this blue or purple area with moderately low profit factor, and then strongly bullish over here, because what that means is I'm trying to buy into a dip, waiting for it to move back into this green area, which means that it's starting to rally higher. And again, I'm going to do a video today showing you this, how to use it, how to trade off of it, and these are longer term trades. So understand that these are really types of trades where you may be able to buy into these, hold on to them for 5, 6, 7 months, maybe longer as the market trends, and these could produce very solid returns on your investment and very solid earnings and dividends for you over the long run. All right, so lastly, I think what I want to do is come back over here and go to gold. We've covered just about everything, but again, a lot of people love gold, and what I want to try to just show you here is the basis for gold, what we have. Whoa, okay, look at that. So I only have about 1,500 bars on this chart, but this gives a pretty good example. You see how this bottom around 1,100, 1,200 back in 2017, and now we're back up into this 1,750, 1,740 level. We've held these support levels. This really shows us that we've gotten into a pennant, a multiple pennant formation, broke out, and now, ladies and gentlemen, we're setting up again a new pennant, potentially like this, and potentially like this. And we're getting very close to a potential breakout. Getting very close to a potential breakout in trend. We're holding above support. This 1,1800 level, actually down here, 1,690 roughly, is very critical support down here. But we're holding up very well, and it looks like right here in alignment with my Bitcoin signal, early September. Somewhere around early September, 7th, 8th, or 9th roughly, we're going to apex off of this gold trigger, and I believe we could see a very big move to the upside. So something is likely going to happen around September. Where's my text? So September 9/6 to 9/8. Pay attention. Oh, drawing these things everywhere. See if I can edit this, make this bigger. So we have an area right here, right in this area, 9.2, right there. There's September 8th. And that's right at the beginning of the apex. So be prepared. Somewhere between September 6th and September 8th, there could be a massive global event taking place. Don't know what it is, but it looks like an apex is going to be reached. That's in alignment with my predictive modeling system for Bitcoin, and it could be a very powerful move. Okay, remember, follow me on Twitter, follow me on YouTube, go to mint.com and create your account if you're not already a member. I'm trying to help you manage and contain your risk. Oh, last thing I want to show you is very, very important, because the real value, where am I going? The real value here that I deliver comes from the ability to see and protect your wealth. Okay, so now most people will end up paying hundreds of dollars a year, if not thousands of dollars a year, to someone to help them beat the S&P and to protect their wealth. I'm delivering that for you for free. But now look at the real value here. My rotational modeling system, the way I'm helping you execute it, has historically beaten the S&P over the last 25 years. You can see here the way this modeling system works. We've got a return of close to $1.6 million compared to about about $640,000 for the S&P. If you would have just kept your money in the S&P, ridden everything out, you would have gone through 15 years worth of sideways market activity and ended up with about a 600% return on investment, where had you put $100,000 in the SPY and followed my rotational modeling system, you would have ended up with almost 1,500% return on investment and ended up with nearly $1.6 million. This excludes dividends, and this excludes continuous contributions, meaning if you would have kept putting money into it, it would have been even greater. Now, what the benefit to this is that we have very strong, consistent year-over-year growth. We are managing our wealth instead of just letting it sit there. And what we're trying to do is to build a capacity for you to grow your wealth more efficiently and more safely than just throwing it into an account and not paying attention to it. So understand that over the next couple of years, we have a huge amount of volatility. You see how this is really from 2018 right in this area till now. The Mint rotational modeling system went from 1 million to 1.6 million, where the SPY went from 440,000 to 660,000 roughly. So this is a 200,000 increase, whereas this is a 600, almost $800,000 dollar increase. The difference here is how we're managing our money throughout downtrends and throughout market rotation. Yes, we do have some downturns. The market is not immune from downturns, okay? But we are managing them very efficiently. And so far this year, we've only got a minus 4%. This is total minus 4% drawdown for this year, which is almost over. So this is, again, the real value. Most people will end up spending hundreds or thousands of dollars a year to gain access to a system like this, where I'm delivering it to you for free right now. And this is really important for you to understand that, you need to take advantage of your ability to learn, manage, and properly execute actions to help you grow your wealth. And that's what Mint.com is all about. Okay, again, follow me on Twitter, follow me on YouTube, like and subscribe. Remember, I'm trying to do this. I spend a lot of time doing this for you every week. I want you to learn and to become better skilled at protecting your capital. All right, so what we're doing is we're waiting to see how this next week plays out. And remember, September 4th, 5th, and 6th could be very, very volatile. Could be some sort of a massive global event. Don't know what it is yet. More than likely banking or Fed or something. I don't know. But right now it looks like that's going to be a very volatile, critical time in the markets. So we'll see how it plays out. Okay, guys, thanks a lot. Talk to you soon.